Amit Kumar Gupta from Fintrekk Capital joins us this morning. Amit, good morning. Thank you so much. Pleasure having you back with us on News9 after a while. Just help us understand what exactly is the mood on the market right now, and there are many factors that could potentially be weighing in on market sentiment. First up, of course, is the mixed bag of Q3 results, especially among the Nifty 50 companies which have declared results so far. No real direction visible and no trend line which could really be established to help investors understand where the market mood is going from here, especially as far as Q3 earnings are concerned.
Yeah, hi Kartik. Good morning. Thank you for having me. Yes, I think the markets are a little bit in a flux, especially the equity markets. Obviously, there are a lot of events which are happening. There was a FOMC meeting which did not had the rate cut as expected. There is a budget coming up. The Q3 earnings are also there. The earnings have been a mixed bag. Certain sectors have shown earning growth much better than what it was quarter on quarter or year on year. But the growth potential for the next 6 to 12 months still remains mixed. So my sense is that earnings growth will be very stock specific and sector specific. And once the budget is out of the way, once the market has digested the budget, then we'll see probably one direction being picked. Till then, I think it's very stock specific.
All right. So stock specific, potentially sector specific, but I want to spend a minute with you, Amit, discussing the India-EU free trade agreement. And what we are seeing, in fact, even on the charts this morning, is that the small cap index continues to outperform the mid cap as well as the larger stock indices, the Sensex and the Nifty. Is it a fair assumption to assume that the MSMEs, especially those in textile trade, leather, apparel, accessories, gems, jewelry, are these likely to be some capitalizations to bet on, if not specific sectors to bet on, especially with all the action that we are seeing on free trade agreements?
Right. I think, India will obviously eliminate duties on almost 93% of the EU imports in this. EU will do it for 99% of the Indian exports. So that's a big boost for labor-intensive and export-oriented industries in India. Some of the beneficiary sectors could be like textile, apparel, leather goods, footwear, gems and jewelry. And all these sectors have been, badly impacted by what was happening with the US tariffs. So these EU deal matters a lot in that context.
Right.
Now, eliminating these tariffs would mean that India can potentially swing orders from countries like Bangladesh and Vietnam in India's favor, especially for firms that already operate at that scale. Most of them are quite a few of them are listed as well, and they can actually meet European quality standards.
Right.
Similarly, I think electronics manufacturing and engineering goods can also gain over time because there also 10% tariffs have been eliminated. European firms, in any case, are actively diversifying supply chains to reduce exposure to China for political and regulatory certainty.
Right.
So my sense is there is a lot of positives in that, but the market obviously may be getting excited in the short term because all these needs to be legally ratified, passed in the EU Parliament, and then it will come on board only sometime in early next year,
Right.
uh, calendar year 27.
Right.
So there could be some changes by then.
Right.
But if there is a possibility of going there, then companies will start preparing accordingly, at least 6 months ahead.
Right. So a deferred positive, if we can call it that, but a positive nonetheless for labor-intensive sectors as far as not just the India-EU FTA, but the FTAs and the agreements that India is signing with countries across the world in that sense. But I want to move back to something you mentioned some time back, and that's about the US Fed keeping interest rates unchanged for the Jan FOMC. Now, again, this is an interest rate, and this is a metric which is absolutely critical for India's IT sector, and India's IT sector has not had a great 2025, and it seems that this pain in IT stocks and investors will have to deal with this pain for what, at least another quarter or so, because it's unlikely that even the budget announcements are going to change anything dramatically for the IT sector. And we've seen that the textbook definition of mixed bag of results is something that the IT sector has shown us in Q3. So overall pain in the IT space likely to continue in your experience?
So I think 2025 was, one of the worst years for IT, and there were obviously uncertainty. But I think valuations are still in favor in a lot of these IT stocks. But one needs to differentiate between what kind of growth trajectory these have. IT services companies, the likes of Infosys, Wipro, TCS, etc., they might show 3 to 5% kind of a growth only, whereas the higher growth could be in the companies which are adapting to AI faster. So my hunting ground would be probably in the mid cap and the small cap space, which can grow by 12 to 15% year on year. Having said that, I don't think budget will be a much bigger issue with the IT companies. It's more to do with what is happening in the US, and in the US we are seeing that interest rates are on a trajectory already. Fed has cut. There could be some more easing into 2026. And AI budgets would also get freezed. So you'll see a lot of companies, especially in the BFSI sector in US, giving out more projects to the Indian companies. So my sense is that 26 calendar year will be better than 25, and valuations are in favor. So I'm not too negative on the IT sector as a whole,
Okay.
but my hunting ground is more towards small and mid caps.
All right. So small and mid-cap IT stocks, and potentially 2026 likely to be better than 2025. I want to move back to budget expectations beyond the IT sector, beyond artificial intelligence. And there is expectation that the government is going to increase its capex allocation to about 12 lakh crore rupees or so. Which are the sectors which are likely to benefit in your estimation and expectation from budget? Do you think this is a good time to potentially accumulate some defense stocks? Is it time to accumulate some infrastructure stocks? What should investors do in anticipation to budget 2026?
So I think I have a slightly different opinion on that. I think budget is unlikely to be dramatic.
Okay.
Instead, it will probably reflect a careful balancing act between supporting growth wherever possible and preserving fiscal credibility and avoiding long-term slippages. So that means the focus should be less on budget day announcements and more on medium-term themes, where companies can grow even in a slower macro environment. I think in general, government hands are tied, so they're likely to stick to the fiscal deficit target. So they had a 11 lakh crore capex last time. I think there is still question mark whether that can be achieved for this current financial year, FY26. I don't expect a higher allocation to that. Probably it will be around that number only, 10 to 12 lakh
All right.
crores for next financial year. So yeah, capex will happen, whether it is defense or whether it is infrastructure. But it is not something which I like to go and buy today. I would like to see some orders actually being allocated in the next couple of months, and then take a call whether I want to increase exposure to these themes. So it's a wait and watch for me as
All
far the
right.
capex is concerned.
All right, and just let's spend about a minute or so also talking about expectations from the economic survey, which is going to be released today. Now, in your anticipation, do you feel that we can look at an 8% growth rate for this financial year, given that we've had fabulous numbers coming in both in Q1 and Q2, 7.8% and 8.2% aggregate for the first half at 8%. And Q3 with the GST 2.0 reforms likely, and not just the GST reforms, in fact, all high-frequency indicators suggesting that Q3 likely to even outperform Q2. So overall, can we expect north of 8% as far as the full year is concerned?
I think Q3 outperforming Q2 was pretty much expected because you had this, 5 weeks of slump down in consumption in Q2 because of the GST changes. So a lot of the demand actually got pushed from Q2 to Q3. So quarter on quarter, Q3 was always expected to be much better. On paper, FY26 real GDP growth still looks respectable. But if you actually dig deep into the headlines, the story becomes a little less comforting. Consumption after the GST cut boom that has again slowed down in a lot of sectors. The private investment still remains very cautious, and the household savings are declining. There have been multiple studies which says that the income growth for both households and corporations have actually weakened over year on year, even if selective tax cuts have supported pockets of spending. So, I will be very keenly watching out how the corporate earnings can be sustained. What is the survey actually showing, and how the government is looking to boost consumption even in the next fiscal year. A major part of that will be coming from the pay commission, eighth pay commission, which is likely to come early next year.
All right, and before I let you go, Amit, I also want to get a quick view from you on commodities, precious metals, gold and silver, and crazy rally we've seen all of 2025 and an even steeper one at the start of 2026. In fact, gold at 1,71,000 rupees per 10 grams, silver at 3,85,000 rupees per kg. And those who have not invested in these metals are now literally living the FOMO life. Have they missed out on the rally, and is it too late for those who have not participated to now enter at these levels?
So I think there was a time to buy it. If you remember last year, we had a conversation. I was very bullish on silver,
Yeah.
and I even said that silver is going to outperform the gold, even though the trajectory for both of them are up. My sense is, after such a sharp rise, there is a lot of speculation which is happening. The margins are actually constantly going up by the exchanges. So the risk of a major correction in February can't be ruled out after such a sharp rise.
Okay.
But central bank purchases are usually long term and rarely reversed quickly. So investor can still hedge against a potential sort of a bubble in AI. But my sense is that things have gone a little bit too much towards the speculation side rather than towards the investing side.
Okay.
Obviously, in silver there is a physical silver shortage. There is a curb by China on the exports. So there are a lot of issues in the physical market. So I'm avoiding exposure, fresh exposure at this point of time. If somebody has any exposure, they can sort of keep a stop loss on their positions.
Okay.
These are like raging rivers. You have the option to jump in and flow in with the current or sit out. You cannot expect to ride a rocky boat and be in control of all this. One who chose to flow with the current, most of the people will make losses. Only a few skilled traders will actually come out winners. So I don't think there is any investment thesis remaining now. It's more like speculation as of now.
All right. We will leave it at that. Amit Kumar Gupta, pleasure having you back with us on News 9. Thank you so much for your time.